Investor Intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.
Hello and welcome to this week's episode of Investor Intelligence, brought to you by the team at the Property Mentors. It's your weekly podcast for all things investment and hosted by me, Phoebe Sikowski-Wallace. So today is a very special episode. It's the first time I've had not one, not two, but three guests at the same time. My first guest is Mario Vinaccia. Mario is a specialist in all things investment, accounting, and self-managed super funds. Welcome, Mario.
Good morning.
I've also got Georgia King. Welcome, Georgia.
Good morning.
And we're lucky enough to be also joined by Luke Harris, who is the CEO and founder of the Property Mentors and our investment expert. Welcome, Luke.
Thank you, Phoebe. Nice to be here.
So, guys, most people at least have a vague idea of what superannuation is. It's the money that you put away for your retirement. Although we're not talking about that everyday super that we all know of today, we're actually going to be talking more specifically about SMSFs, so self-managed super funds. So, Mario, to most, SMSFs can be quite a complex product. There's a lot of sort of ins and outs of them. Would you agree?
Yes, I agree. Yep.
Yeah. And Luke, I've got you here as not only our investment expert, but someone who knows them well from having one yourself, so you can kind of talk to them in that sense.
Absolutely, yeah.
Yeah, for sure. So I have heaps of questions today surrounding the SMSFs. These are all questions that our mentors at the Property Mentors have provided, as these are the most common questions they're hearing and they're getting asked day in, day out about this particular topic. So we really want to cover them off today. So we're happy to get straight into them?
Yeah, go for it.
Fantastic. So Mario, it may sound self-explanatory, but what is a self-managed super fund and what does it allow you to do that a regular super fund doesn't?
All right. The self-managed superannuation fund helps you do your own investments. If you go through an industry fund, basically those investments are already decided for you. Someone who wants to do something outside what most industry funds do, like, for instance, purchase a property, do some mortgage lending through their self-managed super funds, you've got more control and you have more flexibility in what you want to do. Mm-hmm. So that's the benefit of having a self-managed superannuation fund. It gives you more opportunity to invest in other areas which industry funds don't.
Okay. And can you invest in anything with an SMSF? Because surely there's a bit of a catch where people would just sort of buy whatever they want.
Yeah, there's restrictions. Like, for instance, paintings. You can't invest in paintings. Artworks is another part of artworks, paintings, but also some people buy antique cars through the restrictions in relation to what you can and can't do, all right? Because the whole purpose of this is an SMS is to build wealth for an individual for their retirement. It also doesn't allow you to have personal access to those assets. So you can't, like, for instance, a painting, you can't stick it in your office or at home. It has to be stored somewhere else, off-site, away from private use as such. And antique cars, the same thing. Some people like to drive their cars on weekends and things like that. You're restricted. You can't do that.
Okay.
Right? So there's the restrictions in relation to what you can and can't have in the fund. All right?
So Mario, so that means a self-managed super fund, you can buy artwork, you can buy antique cars, you can even buy gold and silver and things like that. But my understanding is you've got to have it stored somewhere else, you've got to have it insured as well, and you can't use it personally. So like you said, you can't hang, a famous artwork on the wall at home. You have to have it stored somewhere secure and have it insured. There's a lot of restrictions on that.
Well, there's restrictions also on the percentage of ownership of what the percentage of ownership in relation to artwork over your overall assets. So you can't go over a certain percentage. I think it's about 5%, George.
Okay.
All right. So if you got $1 million fund and you got $500,000 worth of paintings in there, artwork, well then you can't have it.
Okay.
But the ATO are very restrictive in relation to that type of investments. So you just got to be mindful of that, and you got to do the right things. A lot of people don't. Like for instance, insurance. So many times, previous clients have had artwork in their funds, and for one reason or another, haven't had insurance, and the auditor picks it up, and we've picked it up. So, and there's a breach, so they have to be reported to the ATO, and it starts a roller coaster of what happens with the ATO. So, we want a nice, clean fund that we can do investments with, and then we can build wealth through our retirement.
So taking all of your super and putting it under your own control can sound really daunting. That sounds like a lot of work, especially when you consider all the rules and restrictions that you've just mentioned. Yeah. How important is it then to have the right accountant to help you set it up and manage it properly? And are there risks of having the wrong accountant?
Oh, of course. You need someone who's going to be working with you. So, yes, it is daunting in relation to having your own SMSF, but if you have the team around you that can help you, accountants, the right financial planner, the right mentors, it helps a lot.
Yeah.
With the compliance issue side of things, that's what a good accountant does. He keeps the date with everything in relation to your requirements of lodging things on time with the ATO, and so on and so on. So, and getting the audit done on the SMSF. So we go through that whole process and we guide our clients through all that. So they're not left here, just go away and just, when you come back every 12 months and just give us the bank statements or whatever it might be. We don't do that process. We hold their hands through the whole process. We make sure that the member understands their role and what they're required to do. People like Georgia will send checklists out to clients when it's ready to be done, so they can collate all their information. Most times we have access anyway, so that helps. Like when we have to collate information to do tax returns and so on. And
there are accountants who don't necessarily specialise in SMSFs. Like that's not an across the board. If you're an accountant, you know how to do SMSFs. Or there's some that really specialise it, and others that may specialise in others. Well,
yeah. Look, for instance, myself, I'm also an SMS auditor. So I'm also do all the compliance work with all that. I've got a diploma in financial planning. So I've built a lot of knowledge in that area. You have some accountants that just purely do compliance work, and that's it.
Yeah,
nothing else. But I like to hold people's hands through the whole process, giving them guidance where I can and help them build up their wealth one way or another.
I think also just when you're asking the question about whether some accountants specialise in this or not, the accountant that you see that can do your tax return for $99, for example, they are not the people to speak to about setting up a self-managed super fund. There are also companies online that just do self-managed super fund setups, but obviously when you're talking about setting up something so important, you don't want generic advice. You don't want to talk to somebody that's going to give you a cookie cutter type setup. There's obviously a lot of things which I won't discuss. I'll leave that to Mario and to Georgia, but obviously, you know, the deed that goes into that, obviously behind the scenes, there's the how the fund is going to operate, and all of those things need to come into consideration as well. And you certainly don't want to save money on those things by going to a cheap online version that might not give you the outcome.
Yeah,
that
so
you
it's
need.
not the place to cut corners.
So yeah, it's definitely not. And you're talking about your retirement, your long-term financial future. So having an accounting firm that specialises in investors and really focuses on the investor and their long-term goals and works closely with us here at the Property Mentors to align the long-term goals with the super fund outcomes. It's really powerful to do that. And obviously it's not the area that you want to try and cut corners or save $100 here or there.
Has anyone ever seen any horror stories of people going to the wrong accountant and then you having to fix up the mess?
We've had some whereby even the accounting work that was done, and it was done by a fairly large group. I won't say any names, but it was done pretty poorly. And when Georgia sat through and tried to reconcile the asset values and things like that, it wasn't matching. And their comeback was, we just reconciled everything back to market movement. It just didn't make sense. So the bank account was out of whack. The asset holdings were out of whack. The shareholdings were out of whack. It's
a nightmare.
Yeah.
If you don't have the proper accountant or someone who specialises in that kind of in SMSFs, there is issues.
Yeah.
You need to find the right person, people who understand, like here with us, we take pride of what we do, and especially with SMSFs, you need to make sure that you have the right person who can actually guide you, like Mario said, that can show you that the right way of doing an SMSF and knowing that you can grow this fund, and then when you come to retirement, you don't have to worry about the fund. You know that the wealth is in there.
Yeah.
But yeah, I've had very difficult times with some clients, like not our clients, new clients coming on board because of their SMSFs being just horrible.
Yeah, okay.
They haven't had the proper advice.
I think it's super important if you are setting one up from the start to get it right from the start, whereas a lot of people might just rush into it, go with the cheapest option or go with something online or, do it yourself kind of setup. And then they find that there's problems later on that can cost money and time to fix. And that's just, you do it right from the start and then you're not going to have problems later on.
So speaking of costs, I actually do want to talk a bit about the costs associated with setting one up. So does it cost a lot to get an SMSF set up, and should you have a certain balance before you consider it?
All right. Cost of setting up normally there's a once-off cost. That's basically setting up the deed itself with all the rules and regulations for the fund. There's also the trustee company as such, and that we also establish, and we charge about 2.5+ GST to set it up. All right. Okay. Members' balances, how much they should be using. Look, I know the ATO's got a rule of thumb saying around about 200, but again, it all depends on the strategy you're putting in place. All right. If you've got a strategy it's a long-term strategy and you stick by that strategy, you're more than make it up very quickly. All right. But everyone's different. All right. So you got to look. It's not just sitting there, right there. Let's do it straight away and put whatever you've got, 10,000 or 20. It just doesn't work that much. That's too slow, right? Too low. We have to build that up to a certain amount and then get into investing in a self-managed super fund, because there are compliance costs every year. Compliance costs, you're looking at another $2.5 to $3,000 a year to do. All right, that includes our fee, preparation tax returns, also the auditor's fee. You've got government fees that you pay every year. So they're indexed every year. All right, we try to start as low as possible when we do our accounts, because of the fact that we're in the growing process. But as the fund grows, our fees will grow too, because there's a lot more work involved as such. So yes, there's a cost associated with setting one up and also running it every year. But again, it all comes down to the strategies that you're comfortable with, and you sit down with your mentors and planners or whatever it might be, including us accountants at times, and trying to say, right, this is where we're starting. We're starting at this point. Within the next 5 to 10 years, we should be here, right? And then if you've got a team of experts around you, you sit down every year. You go through that whole process. Where's the fun at? Why isn't it achieved what this is? Property markets, because things are changing at the moment,
constantly,
right? Yeah, constantly. Interest rates are going up. What's happening? Property prices are coming down. They're not increasing as they used to be, right? But how long is that going to happen? We don't know. It's a crystal ball. But, is a property market going to bounce back? Of course it will.
Sure, yeah.
It happens all the time. So you just got to be mindful of that, and people not to panic, because they might buy a property today and they feel it's dropped to 10,000 because of interest rate rises. Don't panic, because long term it's going to jump back.
Yeah,
right.
Yeah.
It's like, I shouldn't say this, but I bought a property many years ago for 109, and I sold it for 750, and there was same property was resold for 1.3.
Yeah.
Wow.
So you can see that property does increase in value if it's in the right area, the income producing side of things, new schools, public transports, and all that. It will grow.
Yeah.
It just takes a little bit of extra time. That's all.
Yeah.
I think when we're talking about fees, we've got to keep in mind that when you've got a industry fund, you're already paying fees. A lot of people don't notice that because it just comes out of their statements. A lot of people, I've seen people that I've lived with, friends and family over the years, they've seen their super fund statement come in, they open it, throw it to one side because they don't understand it. And if you look through that and look at the fees you're paying, you're already paying fees. So the way that I look at a self-managed super fund, and for myself personally, setting up the fund, we looked at the costs of doing that when it was first set up many years ago, obviously with Mario, who's been my personal accountant for 15 years or so now. And we looked at the cost of doing that. And then I said to Mario, I can make more money than those fees. And when we looked at it that way, I was I was very firm. I said, I know I can make more money than what I'm getting from the fund now. And because of that, the self-managed super fund has continued to grow. And what that means is that, yes, the fees go up over time because there's more accounting to do, there's more auditing to do, there's more compliance checks and balances to be done. But what that means is that the fund is actually growing. So if it's growing, that's a good thing. And of course, when we're looking at retirement benefits, it's not money that I can access now anyway. So when we're getting good advice to grow the fund, it's worth paying for, right? Because a lot of people think, oh, the fees are high. Well, you're getting fees for good advice. And there are compliance things like getting an audit done. It has to be an independent auditor every year. And then there's an ASIC fee to keep the fund going. It's $200 or $300 a year. So there are a few fees to consider, but be mindful of the fact that you're already paying fees with your industry fund anyway. What those fees are is going to be different for everybody. But I think the difference with that is that you're getting your own team of people to help you with the decisions rather than leaving it to fund managers who could be sitting in a boardroom somewhere that you never get to meet or speak to.
Yeah. And are the setup costs and all the other costs that you just mentioned there, are they out of pocket or can you pay it through your super?
No, you can pay it through your super.
Yeah. Okay.
So
I think that's a very attractive option for a lot of people.
That aspect, and also as people grow their portfolios, for instance, one of the major things I always look at is making sure that there's a proper life insurance policy in place, right? Because you're borrowing all this money, right, to build your wealth and that sort of things. If anything happens to you, who's the main breadwinner and driving force behind creating this wealth, something happens, well, you want to leave your family, your loved ones, with something to fall back on. And having that life insurance policy, and what a lot of people do is put it through their self-managed super fund to help for that scenario. So, again, it's not out of their own pocket as such, but it's out of their super, and it's providing some wealth protection for the family moving forward.
Yeah, yeah.
So, Mario, if I was looking to set up a self-managed super fund from scratch, I can come to you and all of the costs involved in doing that can come out of the super fund once it's set up.
That's right, 100%.
Not all accountants are the same, and when you throw investment income in with your personal income, things can get complicated. Outgoing expenses, depreciation, loan write-offs, they all need to be handled correctly to make your investment work for you. Finding the right accountant is important. Visit investorintelligence.com.au/accounting to find your next investment accountant.
So almost everyone has a super fund. This is one of the questions that was submitted. So how is it more beneficial for someone to have an SMSF when they have a superannuation already and they don't have to do any admin for it? Surely it's easier for them to just leave it where it is. I guess the question is, how much actual managing of the self-managed super fund do you do yourself?
All right. Well, look, it's the compliance side of things. It's making the decision whether or not you want to go down the SMSF route is basically what do you want to do is your main goal in relation to creating wealth, right? Yes, you can live in an industry fund and not worry about it and put it there. But if you're looking at buying other properties or particular properties, one example would be like, for instance, if I was a panel beater, for instance, right? And I all of a sudden I operate through a warehouse side of things, and also it comes up for sale. I can actually go and buy that through my self-managed superannuation fund. Instead of paying a third-party rent, I can actually pay rent to my self-managed super fund to grow wealth that way.
Yeah.
So there are scenarios where it will work for people as such, but we're here to help. And that's where us as accountants, you have your people like property mentors, and you've got people like financial planners that we work with and all those sort of things to guide through that process. Right? Checklists, we send out checklists. So it's yes, it might be just getting some bank statements together, whatever. It's not a lot of work as such. We do most of it ourselves.
Okay.
All right. But we still need to make sure we tick all the boxes. As members, they need to make sure that they are compliant, and we help them through that process, because there are ASIC rules that certain directors of trustee companies, like for self-management, have to comply with their knowledge and making sure things are lodged on time.
Okay.
Right?
Yeah.
But that's where we come into it.
Okay.
So being self-managed doesn't mean that you're doing all of the work yourself, and it doesn't mean you have to spend 2 or 3 hours a week managing the fund. There's not actually a huge amount of actual work to do. There is some initial work in obviously setting up. There's paperwork. It's like a loan application. You've got to get all your documents together, submit it all to the right people, which is obviously the accounting team. They will do what they need to do, and then they'll contact you for the next steps. They'll let you know what you need to sign and make sure it's all set up and compliant, and it's their job to make sure that it is set up properly. And then, of course, the ongoing maintenance and compliance, there's ongoing communication. The same as you do with a normal tax return, there's tax returns and documents required for the self-managed super fund. And for me personally, doing my own, it's just as simple as doing a tax return and doing all of the other compliance stuff. And really, Mario and his team really saying, this is what you need to sign, this is what you need to read, and this is the next steps. As far as the actual investments are concerned, whenever I'm looking at making an investment decision, I'll discuss it with my mortgage broker and the team and make sure that we're compliant. We're compliant with the CIS Act, which is the Superannuation Act that they've put in place to make sure everyone is compliant. These are things that as an investor you will learn over time. You don't need to know all of this up front. This is the thing that a lot of people, like we mentioned at the start, it is a bit daunting setting up something like this because you're thinking I've got to now be a super fund manager. You don't have to have 20 years experience in investing and do all of that. The reality is that if you're buying property and investing already, it's really not a huge amount different to do it in a self-managed super fund. I've found through my own personal experience, there are some different laws around lending and things like that. But the reality is that it gives me personally the opportunity to build another property portfolio inside my super fund and borrow money, whereas beforehand the super fund couldn't borrow money. And that allows me to have more assets in my superannuation fund than what I had beforehand. So looking at the costs for me personally, I've got more money working for me in the marketplace to offset those costs.
Yeah. So basically, if you've got your team of experts around you, it's only just that maybe educating yourself a little bit more. That's mainly the effort. And as you said, collecting all the documents, which the scheme of things is not that much more effort if you're wanting to start an investing journey anyway. Yeah.
Well, it's like if you start off with a bank account in one property, for instance, there's just the bank statements of the self-managed super fund, your loan statements for the self-managed super fund, and your rental statement, for the annual rental statement you get from the agent who looks after your property. So it's not a lot of information as such. And today you can just jump on the internet and download your transactions from 1st of July to 30th of June every year. So it's not that hard. But some people find it daunting because they just don't want to worry about it. Or think there's more to it. There isn't.
It's just that self-managed term.
But what I always say to members is that you just can't set up a fund and walk away and not think about it anymore.
Of course, yeah.
You've got to actively be involved. It's not a set and forget. And I think if you're an active property investor anyway, and one of our members at the Property Mentors, you're going to have that ongoing relationship with your mentor, and you're going to have those ongoing conversations about your finance and where your next property is coming from and how you're going to finance and structure it. So the most active members that we have at the Property Mentors are always having those conversations anyway. So the most active people, the ones that want to actually get involved in, selecting the properties and looking after the finance, lodging tax returns, they're always going to be active in that space. And it's really good to learn this stuff, learning how these products work and learning how you can actually get a better result. It's all part of your education as an investor to learn what your options are. Now, if you choose to learn about it and not set up a self-managed super fund, that's fine. But at least you've learned the options and you can say yes or no with that education behind. And that's why we wanted to do a podcast today, because we can teach people about what is this big scary SMSF thing that people talk about. It is in the media a lot, and obviously a lot of the property magazines and articles and things that you read out there are talking about it. But for me, it just allows me to go out there and buy more property.
So we touched on it just a little bit at the start, but if you wanted to increase your super balance either before or after moving to an SMSF, how does that work?
Well, your employer contributes every month or every quarter, whatever it might be. So instead of putting it through an industry fund, you're putting it into your self-managed superannuation fund. So it goes through that way. Some people like to also go in partnership with other people. So you can have more than one member in the fund. So you might have 2 or 3, maximum now you can up to 6.
6, okay.
All right. So you can build it that way. So if there's family members, for instance, that want to do it together, by all means, go ahead. They can set up a jointly the fund so that they can share the costs and not worrying about, I'm paying for all this out of my own pocket. It allows you to do that. What some people do, I've got clients that two business partners together in one self-managed superannuation fund that own commercial properties or vice versa, residential properties. They're allowed to do all that. And they're sharing the costs between the two of them. So it gives you the opportunity.
Yeah, okay. Just before we go a little bit further into that, do you still pay income tax on your contributions, or can your salary sacrifice it?
No, well, any contributions made by your employer into a self-managed super fund, you're still paying 15% tax.
Okay.
Even if it's in an industry fund, they're still paying 15% tax.
Okay.
So no difference.
Okay.
Salary sacrificing, you can put more money in the super if you want to as part of a strategy moving forward, but everyone's different, all right? So some people who are nearing retirement do that. They want to put more money into super because they're nearing retirement.
Yeah.
Some people are younger. At this point, they might do that as a saving mechanism, but they know they can't touch it because there are some people that just spend.
Yeah.
And there's a way of life today. So, and that's what they find as a way of putting money away aside for their retirement. But it also depends on what you're doing outside the self-managed superannuation fund. You don't want a salary sacrifice and then all of a sudden your cash flow strapped on outside the fund and you can't make your mortgage repayments in your family home or other investment properties you may have. You just got to weigh all that up as such. So everyone's different, and that's why you need to sit down with an expert, being a financial planner or their accountant, also at the same time to work together to work out the best outcome for everyone.
So whether salary sacrifice or contributing extra funds or renegotiating potentially with your employer to increase your superannuation payments, that's not something people have to decide on their own. They can have that conversation with yourselves as accountants to work out how the tax side of that works. And that's the long version of accountant is tax accountant. That's essentially what accountants are. They're there to look after your tax and making sure that you can get the best outcome. So it doesn't suit everybody, but some people are on a higher income, or like Mario said, on getting to that age where they're starting to think about retirement a little bit more, maybe mid to late 50s, and they really need to think about that. And sometimes the advice can be to contribute a little bit more to super as you're getting closer, because if you're in your 20s, you can't access that for 40 plus years. So if you're getting closer to retirement, then you can access it sooner. So it does suit some people to do that. And we've had a lot of people that have put that in as part of their strategy. But I think just because you've got a self-managed super fund doesn't mean that you have to make those decisions yourself. So that all comes into your tax planning and your retirement planning. And this is why it's important as an investor to have these conversations, because it gives you all of the options on the table. Whether you say yes or no to them, at least you know what those options are.
Again, that's really good to know, because I think that alongside that self-managed term, you don't have to make all those decisions yourself.
Well, you have, like I said before, you have a team around you that help you, guide you through that process to make a decision that's going to be beneficial for you personally. Right? Everyone's different. Everyone's circumstances are different. Yeah. That's why you need a good team of experts around you. And
at the end of the day, it's still their choice. But after they've spoken
100%.
To,
100%. Yeah. Everyone has to make their own decisions, and in the end of it all, they're going to be comfortable with.
Yes.
Right. That's one of the things I always stress. Is if I find that someone's not uncomfortable with something, stay away from it.
Yeah.
Right. You need to be 100% behind it and comfortable moving with that strategy.
Yeah.
Because like I said, it goes up and down. There's a roller coaster at times. Like interest rates go up, property prices are starting to come down a little bit. Right? You need to be mindful that what's going to happen. A great example was GFC when it hit. Right? I look after a lot of SMS for a lot of elderly clients. It's amazing, but there's a lot of elderly clients out there who have SMSFs. All right. When we had the GFC, they all went into panic mode. Oh my God, my share portfolio has dropped by half. I've lost it. Well, just calm down. You just guide them through the process. Look, you're pulling out a pension every month. Is that being affected? The dividends are still being paid. Right. So therefore they don't need to sell the shares to supplement their pension, because they're still getting enough dividend income. Yeah. So let's ride the storm, because eventually the share price will come back up again. It has. So and it's guiding through that process for a lot of people, helps them a lot.
Yeah.
So So yeah, it works well. So and that's why I said you just need some to guide and just calm people down in relation to, and think outside. It's not all doom and gloom. There's a process we need to go. And sometimes you need that expert to say, let's take a deep breath. Let's go think about it a bit more clearly, and let's take one step at a time.
Yeah.
Look, and I think that's the thing is having that team approach, like we mentioned in Let's Get Real in the first book, is having that team of people and knowing what advice you need to get from who.
Yeah.
It makes you a better investor. The more questions you ask, the better investor you're going to become, and of course, the better investor you become, the better results you should be getting over the long term.
Yeah.
Absolutely. So yeah, one of the next questions was actually to do with the structure of SMSFs and if they're similar to a retail fund, meaning one person per fund, or can you have more? You've just said that you can have up to 6 people. But if you can have more than one person in the fund, what happens when, say, one of the members retires, or worst case scenario, one of them passes away before retirement?
Oh.
Do the other members inherit the super? What happens there?
No. Well, there's a number of processes in there, like death benefit nomination forms as such, that gets completed. Some of them go for about 3 years, and some are binding as such. And that determines where that member's balance goes to. All right. Now, in a fund, if you've got more than 2 or 3 people, each person in that fund has a member's balance.
Okay. Yeah.
And that's part of the process we do when we do the financial accounts, the compliance work. We say, this is what your members' balances are. Because you might have a situation whereby someone contributes more money than the other.
Okay.
Right? Therefore, because they're contributing more, they get more of the profits as such, because of depending on the percentages.
Yep.
So no one's disadvantaged as such. But when a person passes away, a member person passes away, it then falls back in that death benefit nomination form, which normally determines who goes to. Some people say as per their will. Some people allocate to their spouses as such.
Yeah.
So it's just different in everyone's circumstances.
Okay, that's good to know as well, because I feel like there would definitely be cases where people go into one and then, I don't know, they might have a falling out in some way or another, and then that gets a bit messy. But if you've got member balances and it's recorded at how much people contribute,
and everyone signs off on it.
Yeah, okay.
It's not like one person, my member signs off for everyone's. Everyone signs off on it.
Okay.
So everyone has the opportunity to review what they've been given and to come back to questions like to Georgia or myself, and we go through and explain how we arrived at these balances as such.
Yeah.
And normally it just you sign off and that's fine. When you have a certain or there's a business split or a marriage breakdown, all that changes things, right? And that bit, sometimes when it's a marriage split as such, the family law courts determine what goes where, right?
Yeah.
As part of the deal with splitting up assets as such,
Okay.
right? So, everyone's different.
Generally, for setting that up, if you've got up to 6 members, it used to be 4 a little while ago.
That's right.
And they've just changed it. And there was talk of it going up to 10 or more, I think. I don't know if that's going to happen. But generally, those people would be people you know. They're going to be family members or someone that's already very close to you. Not likely, and I haven't experienced it where you're 6 complete strangers or friends get together and set up a self-managed super fund. It's usually brothers and sisters, cousins, and people that are very close to you anyway. So there is obviously family disputes from time to time, but that's covered in the deed, how things are treated.
Okay.
And it's like setting up a company. When you set up a company in a trust structure, it's all documented how certain things need to be done, tax returns and appointing the accountant, for example. All those things are covered off in those documents so that everybody knows what's going on. So it minimises the chance of disputes coming up over how things are to be done.
That's good to know. So to sort of wrap up this episode today, who's the best person to talk to get started with this? Because I know financial planners and accountants kind of have different jobs as far as SMSFs.
Yeah, it's a little bit difficult as such because of the ASIC rules associated with the rules at the moment in relation to establishing an SMSF. If a client comes to me and says, Mario, I want to set up an SMSF. All right, so then I said, that's fine, we can set it all up, but do you know the pros and cons? No, I just want to set it up.
Yeah.
That's brilliant. Where someone's umming and ahhing and wanting advice, well, then you need to fall back and get a financial planner, all right, to come back and say whether it's going to work for them. Now, they have to understand to a certain degree what the strategy is, right, number one. because when a financial planner sits down, he follows, like, for the risk assessments of the individual is one. Number two is what the ATA requires, the 200,000 as such.
Yeah.
So they need to understand this is what the financial planner is working around, and they've got to comply. They can't not comply because ASIC will go after them.
Yeah.
Right? Might not be the member, but it'll be ASIC.
Yeah.
Right? And they've got to hold their licenses. Right? So it's a matter of understanding where the financial planner is coming from, and also what your strategy moving forward is. Right? And then it comes down to the member making the decision whether or not they proceed with the SMSF, or yes, they're going to go with it. I'm more than comfortable with it. Let's go ahead and do it.
Mm.
But everyone's different as such. But everyone's working to a set of rules, government rules. So you just got to be mindful of that.
I think the tricky part is that if you go to a financial planner, and I've experienced this myself, they can't talk about residential property.
That's right.
So whenever they're talking about giving advice, they're only talking about the advice surrounding the financial products that they can offer, which is a share portfolio or something that has a product disclosure statement. There's trillions of dollars worth of Australian residential property out there, and every single property is different. So there isn't a product disclosure statement for every property out there. It's just impossible. So a financial planner can't actually talk about buying a property, a specific property, and getting a loan against it in your self-managed super fund. They can't talk about that.
Okay.
So this is why I guess a financial planner has a role and responsibility in this. But if you go to a financial planner saying, I want to build a property portfolio, they can't give you advice on it. It might form part of the strategy.
Yeah.
But of course, at that stage, they're also going to be looking at how they can diversify your funds as well. So even though it might be a self-managed super fund, the financial planner is still going to help with various parts of that to diversify some of your funds. So you might want to go out there and set up a self-managed super fund and just buy property. The financial planner might advise against that because they might suggest that you need some money in the stock market and various other things as well. So it's going to be different on a case-by-case basis. But generally, from my experience, when I've gone and spoken to a financial planner, they've told me not to put all my money in property. Yet property seems to have worked pretty well for me so far. So, I think that's where the self-managed component comes into it, is that you, to a certain extent, need to tell your advisors what you want to do, and then go down that path and making sure that you're asking questions about what your end outcome is and how you want to structure that.
Okay, because I was under the impression you probably engage both an accountant and a financial planner. Would you say you would still engage both, or is there sort of one over the other?
You do need it, because when you're going for finance through a self-managed super fund, they need some of the finance companies actually need a financial planner letter to say they agree, they understand the process.
Yeah,
that's a bank's wanting that information.
Yeah.
So you do need to go through see financial planner.
Yeah. And you will need them for insurances and things as well.
100%, 100%. Because and also, like, you might have a property in there, but there might be excess cash. You're going to stick in a bank account earning 0.5%. You're not going to do that. You want to look at building that up too. And that's sort of thing. That's where a financial planner can give you the opportunity to look at other products as such. All right, like a portfolio of shares. Once you've got that property there too, so it helps you. They guide you through the different types of investments. It isn't just property. They've got shares, property trusts, all that type of things.
I think there's different layers to it. So obviously, making a decision that as an investor you want to set that up. If you want to do that, then of course you can speak to the accountants. They can set the super fund up for you. You can speak to your mentor about which properties to select. You can then, if you've got excess cash, if you want to put your money into property, you can do that, and you might have $20,000, $30,000, $40,000 left over. You can speak to the financial planner about getting the best outcome for that, because obviously after you've bought the property, you can have ongoing superannuation contributions coming from your employer. So your balance is going to continue to increase. Generally, in a self-managed super fund, your loan against the property is going to be principal and interest. So over time, that loan's going to be reducing, and you're going to have excess cash in the portfolio. So you're going to need a financial planner at some level, look after your life insurance and other insurances you need. Property-based insurances, such as your landlord's insurance, that's separate, that's outside of your super fund. So your financial planner is not going to give you advice on that. But of course, there are multiple people involved. And this is when we talk about having an expert team around you. It's not something that you're going to learn necessarily straight away. Some people, this is really confusing stuff. Some people, they understand it. They understand the financial world a little bit better than others. But the main thing is learning, asking questions. And this is why we've had a Q&A today really is to make sure that we're covering off a lot of the general sort of questions. Obviously, if somebody's going to speak to Mario and Georgia, a lot of these questions will already get asked, so it probably saves you a little bit of time covering off, these types of questions. But obviously, for everyone's situation, it's going to be different as to what their end outcome is, and obviously, your age is going to be a big contributor to what your strategy is as well. If you're in your 20s or 30s, you're going to have a very different plan and strategy to someone in their 50s or in their 40s.
Yeah, because when someone younger doesn't have a lot in super at this point in time.
Yeah, okay.
Right, so compared to someone who's my age, I won't go into detail with that one, but
20, 30,
I wish. But have money put away for starting, because I'm getting close to retirement. I'm going to start planning for all that. So I'm now, as a strategy for me personally, I'm putting more and more super in away this year and over the last probably 3 or 4 years now. And time progresses, I'm going to put a little bit more because I want to start building that side of the of my retirement aspects of it all, because I've been accounting practice, brought a family home, and I did all those types of things, and I've paid that off, and so it's now working towards getting to a situation whereby I've got to start looking at more retirement. We don't stay young forever, but it's something important that we all need to do. So
yeah. So the best person to talk to, or the best people to talk to, is your team of experts, essentially.
That's right.
Yeah. Okay. Well, I want to thank you all for being here today. There were actually quite a few more questions provided by the mentors as to, what they're being asked day in, day out about SMSFs. However, we will wrap it up there for today. Mario, thank you very much for your time. Georgia and Luke, thank you so much.
Thank you.
Thanks, Vivi.
If you found this episode or any of our episodes helpful, please make sure to share and leave a rating to help us reach more people on their investing journeys. And of course, subscribe to be notified when new episodes drop. Make sure to follow the podcast on Instagram at Investor Intelligence Podcast. You can find links to our other socials in the show notes, including a link to the Property Mentors weekly blog. If you're ready to get your property portfolio in shape for financial freedom, check out Luke's latest book, Property Fit. You can get yourself a copy at www.propertyfitbook.com.au.